A strong jobs report is steadying nerves on Wall Street this morning, but it is not exactly setting off fireworks. S&P 500 futures edged higher in early trading after the latest labor market data came in firmer than expected. The US economy continued adding workers at a healthy pace, and that gave investors just enough reason for cautious optimism to nudge futures into positive territory. Not a surge, a measured move. Here is why that matters. Employment data is one of the clearest windows into the health of the broader economy. When companies are hiring, workers have paychecks, and when workers have paychecks, they spend. Consumer spending drives roughly 2/3 of US economic growth. So a strong jobs number is, at its core, a signal that the engine is still running. But there is a catch, and markets are sitting right in the middle of it. Treasury yields held at elevated levels after the data. To understand why that matters, a quick reminder on how bonds work. When investors sell bonds, prices fall and yields rise. A robust labor market can push yields higher because it suggests the Federal Reserve may not be in a hurry to cut interest rates. Strong hiring can keep wages rising, and rising wages can keep prices elevated. Exactly what the Fed has been trying to cool down. That creates a real tension for stocks. Good economic news supports corporate earnings. But higher borrowing costs make it more expensive for companies to grow, and they weigh on what investors are willing to pay for future profits. The modest gain in futures reflects that tug of war. Markets are not selling off on the data, but they are not running with it either. The Fed has been consistent in its message. Officials want more evidence that inflation is actually coming down before they start cutting rates. A tight labor market complicates that picture. It keeps the economy from slowing in the way the Fed might need to feel confident about easing policy. So where does that leave investors? Effectively, pricing in a scenario where the economy holds up reasonably well, but where meaningful rate relief from the Fed stays limited for now. That is not a crisis. It is just a slower, more grinding path forward than some had hoped for at the start of the year. The next major test arrives with the upcoming inflation data. If it confirms the economy is cooling gradually, the picture could come into clearer focus. If it surprises to the upside, the timeline for rate cuts gets pushed out further, and the balancing act in markets gets harder. Watch the inflation print closely. It will tell us whether today's job strength is a comfort or a complication. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.